Hi, my name's Nick Milliken, Managing Director of CAIS IQ, and we're here today to talk about Recover, Rebuild, Renew, framing the current potential opportunity. The long march back to normalcy from the depths of the pandemic is showing solid signs of progress. As we enter what is hopefully the final stage of the pandemic, we've identified three distinct but related phases that may present different investment opportunities going forward. The three R's: recover, rebuild, and renew. Public markets have continued to recover from the depths of the pandemic-induced market sell-off, with all major domestic markets now trading at all-time highs, all while the global economy is still catching up. As it does, it is anticipated that we will experience periods of dislocation and uncertainty due to macro factors, geopolitical tensions, and the ongoing complications arising from vaccinating the global populations. These periods of disruption may provide opportunistic entry points into long-term strategic investments such as private equity, debt, and real estate, as well as potentially allowing investors to gain from tactically shifting to markets, regions, and sectors that experience differing paces of recovery. Against this backdrop, we are seeing advisors seek to protect the gains from the recovery so far, while continuing to participate in the ongoing economic recovery. As countries and regions rebuild in the wake of the pandemic, it is becoming increasingly clear from our discussions with fund managers that they believe the global economy has undergone a structural shift that has likely changed the future opportunity set in several key ways. Firstly is the rapid acceleration in the adoption of digital technology. A 2020 McKinsey survey found the pandemic had speeded adoption of customer and supply chain technology by 3 to 4 years and digital-enabled products by 7. Additionally, the shift from brick and mortar retail accelerated due to lockdowns and social distancing mandates, with an EY survey finding that the pandemic has changed the way 80% of consumers shop, with 60% of respondents doing less in-person shopping today than they did pre-pandemic. This has potential implications for traditional retail real estate, but may create opportunity for infrastructure and warehouses that support the online economy, not to mention the technology companies transforming entire industries. Looking to the markets, the pandemic snapped the bull market in domestic equities, shaking investor confidence that traditional investments and strategies can deliver the same risk-adjusted returns in the future. Numerous capital market assumptions from asset management companies such as BlackRock and AQR anticipate the global 60-40 stock bond portfolio returns to be in the low to middle single digits over the next 5 to 10 years. Compounding the issue is the massive global monetary and fiscal response that has stoked inflationary fears, threatening to reduce real returns. The response from the market has been heightened volatility, albeit placing it back to a normalized range, as well as a repricing of bond yields. This comes at a time when interest rates are at historic lows, with little to no place to go but up. Such a situation offers investors little in the way of income or immunization against equity market volatility, as they have done so traditionally. It may not only require investors to cast a wider net for income alternatives such as private debt, real estate, and infrastructure, but also to look to uncorrelated assets such as global macro, equity market neutral, and event-driven hedge funds to seek to offset equity market volatility and potentially deliver positive absolute returns irrespective of the movement in broader markets. Structured solutions with the defined outcomes may also play a role in navigating the future market uncertainty and gyrations. Taken together, all of these influences potentially create an opportunity for investors to consider how to rebuild their portfolios. Finally, the US appears to be entering a period of renewal in confidence and opportunity. The intergenerational wealth transfer from baby boomers to millennials is projected to reach $68 trillion over the next 30 years. Of this amount, it can be expected that a large portion will find its way into ESG and impact strategies, as well as digital assets, given the preferences of millennials highlighted in several recent surveys. Firstly, one survey found that close to 75% of millennials believe that their investments can directly influence climate change, and that they are twice as likely to invest in companies that have positive impact on the world. Additionally, 67% of millennials say they prefer digital assets such as Bitcoin to gold as a safe haven asset. Another report found that 67% are more open to using cryptocurrencies today than they were a year ago. As this generation's investors inherit the wealth of their parents, these preferences are likely to accelerate these broader themes. Hedge funds are also experiencing a renewal in investor confidence and interest following their performance during the turmoil of 2020. After trailing the performance of equities for most of the last decade, the volatility experienced last year drove dispersion within risk assets and helped hedge funds deliver their highest absolute return since 2009. This strong performance has carried over into 2021, causing advisors we're hearing from to reassess the potential role that hedge funds may play and tapping these strategies to seek to defend against future uncertainty in the markets. Hopefully the 3 R's, recover, rebuild, renew, provide a framework through which to view the opportunities ahead of us as we overcome one of the most challenging environments many of us will experience. To learn more, visit www.caisgroup.com/insights or contact your CAIS representative. Thanks for spending the time with us today.